After recording this, I felt like my thoughts are a little all over the place. So I need your help in understanding if this video brought value to you or if what I say in this video about the stock market makes any sense at all. Let me know in the comments below, and if this video was too everywhere for you to understand, just tear it apart and throw it in the dumpster. According to the latest unemployment data that came out earlier this week, the jobless claims have dropped below 500,000 for the first time since the pandemic first began last year. Even though the economy hasn't completely opened yet, more and more people are going back to their jobs and have started getting their paychecks on a weekly basis and are now going out and spending money on buying the latest and the greatest things, new clothes and fancy cars. On the flip side though, there have been rumors surrounding inflation in the market and how if the economy opens up too fast, we might see hyperinflation in this country. In this video, I want to take a few minutes to share my thoughts on if we will be seeing inflation go crazy in the next few months and how this might affect the stock market. What's going on, guys? Welcome back to my channel. This is Shuril and you're watching Modest Millennial, where we talk about all things money that they don't teach you in school. First, I want to help you understand what inflation is and how it erodes the buying power of your money. But more broadly, I want to talk about how a sudden rise in inflation can cause chaos in the economic system of a country, causing a massive sell-off in the stock market, pushing prices of produced goods significantly high, and losing a lot of people a ton of money. We will then relate this theory to the current market situation and discuss a little bit about the climax of events since the pandemic first began, leading up to here, that is pushing us to test the theories of inflation. So go ahead and hit the like button for the YouTube algorithm and subscribe to my channel below for more weekly content. Creating a video like this takes me about 18 hours from scripting to editing and uploading, and my poor puppy gets sad as that eats into his playtime. So the least you can do for me is at least like this video. Let's start by talking about what inflation is and if it has a positive or a negative impact on the money you have saved up. Just generally speaking, inflation basically is a rise in prices of everyday things such as housing or gas or even groceries or even eating out from the economy growing. As people's buying power goes up, things have to cost more than what they did about a year ago or even a month ago. Otherwise, the demand in the market will far exceed the supply of goods in the market and will end up causing severe strain on the supply chain for a country. So then, inflation should be a good thing for the market, right? It kind of is in a way. Traditionally, inflation in the United States has grown by roughly 2% per year for the past several years, and that hasn't been an issue for the markets or for people's savings. Normally, your salaries from your 9 to 5 jobs grow by roughly 3 to 5% a year to account for the increasing cost of living, and your investments, depending on where you have invested your money, grow anywhere from 1% to 10% per year. So why is it now that we are so concerned about inflation rising and causing a massive chaos? Well, a lot of things have changed over the past year, and all of us are now living our versions of new normalcy, and I don't even know where to get started with explaining to you the things that have led us to talk about chances of a stock market sell-off anytime soon. Let's start by talking about what we know so far. What happened last year was that the pandemic hit the world literally out of nowhere. It was like a sudden punch in the gut, and since there were a lot of unknowns and a ton of fear among people about the illness spreading rapidly, the economy was abruptly shut down in the beginning, but then slowly started opening up. Government intervened by introducing one stimulus package with $1,200 checks, and then another stimulus package with $600 checks, and then another one with $1,400 stimulus checks. PPP loans were being given out to small businesses to stay afloat while being completely shut down. Oh god, my head is spinning already. Mortgage and rent forbearance went into effect. The feds jumped in and slashed interest rates all the way down to zero. A ton of people lost their jobs from the economy shutting down, but almost all states started giving out an extra benefit on top of the usual unemployment payment to keep such people afloat and paying at least for their needs such as food and health. The stock market, and how have we not talked about this yet, crashed like there was no tomorrow. It went down by more than 30% in less than a month's time. But then as soon as the first stimulus was announced, the market started going back up again. And to date, we are waiting for it to pull back so we can buy more stocks. Between the bottom of the market in March last year and Friday last week, the market has gone up by 93%. Guys, this means that if you had invested $10,000 at the bottom of the stock market crash last year, today that $10,000 would be worth almost $20,000 without you even touching that money. The question on everybody's mind right now though is, does this whole situation look a little too fake to believe? Are we absolutely sure that the market is already pricing in all the unknowns out there? And if ever these unknowns are to bubble up to the surface, is the market going to continue to do okay or come crashing down like it did last year? Well, let's think about this for a bit. There are two things that I feel can crash the stock market. Now, this is more in general and not in particular for this situation. First of all, when there is fear or uncertainty about the future, the market will act violently and crash. We saw exactly this happen last year when the pandemic first began. The second and the more slow death sort of way is due to increased costs for products, lower salaries, or unemployment. and higher interest rates, basically any situation in which it costs higher for corporations to run their business. Say for example, you are a lemonade stand and it costs you $2 to make 1 cup of lemonade. But now raw material pricing has gone up, sugar, lemon, bottled water is all more expensive than it used to be before. So now it ends up costing you $2.50 to make the same cup of lemonade that used to cost $2 before. This might be fine for a lot of your customers if their salaries are rising at the same time too. But now people will think more before buying your cup of lemonade and would rather save their money for a rainy day than spend that extra 50 cents. This means that your sales decline over time over the next few months as people look away from buying your product, and when you present your earnings, they come out to be lower than what they used to be in the past. This causes a massive sell-off in your stock and the stock value plummets. But your one lemonade stand doesn't form the entire market, right? Your company is probably 0.00001% of total value of the market. So then a sell-off in your stock shouldn't crash the market. But it's not just your company that's facing increased cost. All restaurants, all shops, auto repair stores, gas industries, and the housing market, everyone is seeing an increase in raw material costs due to rising demand. This affects the earnings for all companies that form the market and thus creates a potential situation for a market crash. In regards to how this analogy relates to the current market situation, let's think about that for a minute. Like we discussed earlier, a lot of people were sitting at home without a job for the major part of last year and collecting unemployment plus a few extra $100 per month from the government. Now, the government only has so much money to keep paying people without having them contributing in the economy. At some point, the government will raise their hands and walk away from incentivizing the jobless population. How does this affect your money, you ask? Here's how. Once government stops paying people, more and more people will eventually have to get up and start looking for a job. There will be a massive storm of people looking for jobs at the same time in the market, but only so many jobs exist in the market, which means that only so many people will actually start getting their paychecks again each week, which means that money circulation will go down and more people will start filing for bankruptcies. But keeping aside the bankruptcy aspect, let's focus on the less money circulation issue. When people have less money to spend on things, they are not going to come to your lemonade stand to buy lemonade each day, or they are going to spend less on buying new shoes that year, or they will travel less to save on gas each month. The combined effect of all these things will lower the quarterly earnings for a lot of companies that purely rely on people's purchasing power for their profits each month. Once people start spending less, companies will make less money. Once companies start making less money, they will have less profits and lower earnings each quarter. Majority of stockholders will see this as a sign of weak economy and rising inflation and will start selling their stocks, which will lead to a massive sell-off in the stock market. The other catalyst, and kind of a big one right now, is interest rates. When the government sees that the economic growth is weakening, they start lowering the interest rates so as to incentivize people to borrow more money and in return spend more money to stimulate the economy. We saw the Feds jumping in at the beginning of the pandemic last year and lowering the benchmark interest rate all the way down to 0%. This caused borrowing such as mortgages, car loans, personal loans, and such to become cheaper, and in return we saw the biggest boom in the housing industry over the past year, where housing prices jumped by about 17% in just 1 year. But as the economy begins to open up later this year, interest rates are expected to start rising again as people's buying power is expected to go up. But wait, is buying power really going up as a lot of people are still unemployed and don't have money to pay down their bills each month? As interest rates rise, it gets harder and more expensive for corporations to borrow money to run their operations, and thus two things happen. The first is that the prices of their products go up to account for higher cost of making them due to the higher interest rates. And second, if income has not been keeping up with a sudden rise in rates, then people will find it less appealing to spend their money right now when prices are skyrocketing for even daily products such as gas and groceries. This is another catalyst that fuels a drop in earnings for corporations and causes a sell-off in their stocks. Once again, the more companies that go through this crisis, the more the market drops. See, in a usual non-pandemic situation, the way things are supposed to go are as follows. Economy starts crashing, so the government jumps in and reduces interest rates. Once the economy starts climbing up again, the Fed slowly start raising the interest rates and more people can spend money that is more expensive to borrow as they're making more money to pay it back. This situation is a little unique as we have seen the largest unemployment over the past 50 years or so, and as we are heading towards some of the critical benefits from the government being withdrawn, a lot of people still are unemployed and relying on money from the government to live their life. So once we get back to some sort of normalcy, it is expected that unemployment will still be relatively high and will cause a panic in the stock market. But again, who am I to critique the stock market? You just happen to stumble upon this random dude on YouTube because he was one of your recommended videos. I'm not a financial advisor, so don't make any reckless decisions with your investments based on what we just discussed. And do your own research or talk to your financial advisor before taking any actions. Once again, thanks so much for watching, guys. As always, don't forget to smash the like button and hit the subscribe button for the YouTube algorithm. And don't forget to tune in again next week for more content on personal finance.